Hi, I'm Steve Bigger, Director of Equity Research for S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is Joe Agnesi, Food and Drug Retail Analyst. Joe, welcome to the program.
Thank you for having me.
So this week's focus stock of the week is CVS Corp. Can you tell us a bit about the company?
Sure. Most people are probably familiar with the CVS retail drugstores. They have over 7,500 stores in most states, conveniently located close to people's homes. Within those drugstores, approximately 2/3 of sales come from the pharmacy part of the store, which drives the traffic. The front-end non-pharmacy goods are only 1/3, but they are wider margins, so we think the profitability is about half of the retail portion of the company. The company is also the largest operator of in-store healthcare clinics. Minute Clinic is the name of their in-store clinics. They've got 700 clinics, and they expect to double the number of clinics in the next 3 years. What people may not be as aware of is the pharmacy benefit management portion of the company, which generates half of total sales and about 1/3 of the operating profits. What PBMs, pharmacy benefit managers, do is they administer healthcare plans, and they also operate very large mail order pharmacies and specialty pharmacies.
So what are the growth drivers, would you say, for the company?
Well, I think the two biggest near-term growth drivers are the implementation of the Affordable Care Act, which will drive prescription volumes, and the aging of America. As people age beyond 45 years old, the prescription usage per person increases significantly. As far as the Affordable Care Act, we expect eventually up to 30 million people to receive health care insurance. Once they do, we think that they will access their conveniently located retail pharmacy stores, shop based on convenience. And also we think Caremark is particularly well positioned as an administrator to the health plans that are going to be offered through the healthcare exchanges set up in the states.
So what about the valuation of the stock? What's your target price? How are you deriving that?
We have a $70 12-month target price, valued at 17.7 times our 2013 EPS estimate of $3.96. This is at a 5% premium to the broader S&P 500, which we think is warranted given their strong market share positions and the favorable industry trends. It's also at a slight premium to their closest peers.
How about risks? What would you highlight there?
I would say the two biggest risks are probably the increased role of government in healthcare, which would likely lead to increased pressure on drug reimbursement rates. However, we think that the increase in volumes that they're going to experience through the aging of America and also the Affordable Care Act will more than offset that margin pressure. Also, there's some risk due to a weaker economy. The non-pharmacy goods within retail stores are somewhat reliant upon a strong economy and consumer discretionary spending. So there could be some pressure on prescription volumes on the front end in a weak economy.
Great. Thanks, Joe.
Thank you.
And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.